When markets feel uncertain, the biggest risk isn't volatility, it's the decisions people make because of it. Right now, headlines are dominated by geopolitics, uneven growth, the oil price, and shifting expectations. And for many investors, that creates a simple but uncomfortable question. Do I stay invested or do I get out? Welcome to Everything Counts. In this bi-weekly podcast series, we frank about money and the discussions we should all be having. My name is Mutao Khoripe, and today we're cutting through the noise, joined by Investec's chief investment strategist and host of the podcast Macro Monday, Chris Holdsworth. Chris, welcome to Everything Counts.
Yeah, thanks very much, Mutao. Looking forward to it.
It seems and feels like at the moment, the only certain thing is uncertainty. And when you are investing your money in different portfolios, you do worry at times like this. What is causing so much uncertainty?
That's a bit of an interesting story. I mean, the best gauge of uncertainty in markets is a series called the VIX. And it gives an indication of market expectations of volatility over the coming month. And typically at uncertain times, that series will go up. And in more tranquil times, that series will come down. Now, as a guide, over the long run, the average for that series is 19. In March, it got to over 30, but strangely enough, at the moment, it's at 17. It's actually below average. So the market is taking a sanguine approach at the moment. It's somewhat relaxed. It isn't as volatile as you might think reading the headlines. Now, what drove the volatility in March was issues coming out of Iran and the consequences for global energy prices and ultimately inflation and growth and interest rates, and a lingering concern around debt problems, particularly in the US. But given all of that, it is quite bizarre to think at the moment we're seeing below normal volatility in markets. So actually, we're looking at a relatively calm environment compared to the average.
So how does one cut through the noise of what's happening in the headlines to what really the numbers are saying?
It's very difficult to differentiate between signal and noise, especially in an environment when we have so many headlines and the consequences could be so dramatic for the global economy of something going awry. It is tough. It's our day job, in effect, and it's difficult even for us. So for a layperson out there who's just bombarded by noise, I would suggest it's near impossible to try and differentiate between what is likely to be consequential for markets in 12 months' time and what's not.
But that noise does cause some sweaty palms, right? And it shifts the behavior of investors. So people trading on news and sentiment instead of solid numbers, how can they better sit on their hands and make sure that they make more sound decisions when it comes to their money?
Unfortunately, it's a natural response for humans to be concerned in an environment like this. There's a number of studies which have shown that people are loss averse, and typically a loss will hurt about 2 times as much as a gain will benefit someone, roughly. And so when there's a prospect of a loss, people naturally become nervous. Unfortunately, it's a characteristic of markets that there will be periods of losses. And that's part of the reason that you get rewarded for taking on that risk, because it is so uncomfortable for so many people. And so in some respects, it's uncomfortable when it happens, but in the back of your mind, you know that is why you're getting rewarded, because of risk like this.
Now, when things like this happen and there's a lot of chaos in the market or maybe geopolitical movements, a lot of people tend to be first actors and see it as an opportunity. Others tend to cower because they don't want to lose their money. What's the best first reaction to when something like this happens with big headlines, big geopolitical movements, or a president has said something that moves markets?
Typically patience. If you go back over time and you look at prior geopolitical crises and the impact for markets, people who had been patient are typically the people that would have done best. Initially, there's some form of sell-off, and often you get a recovery subsequent to that. And if you try to time the market and you try to sell out immediately to try and miss the drawdown, and then you're going to try to buy it at the bottom, you're likely to miss out. At the turning point of COVID, I think there were very few people that expected that would be the bottom. For the global financial crisis, I think there would have been very few people that would have picked the bottom exactly. And the risk of missing out on the subsequent rally off the bottom is so great that often it's better just to try and be patient and try to ride through the volatility.
So not trying to lose money during a time of chaos can end up becoming a gamble, right? So let's deal with the question most people are sitting with. Should I stay invested or should I move the cash?
Well, I can't give advice on a podcast like this. It depends very much on an individual's personal circumstances, always. But what we can say is something along the lines of we know that markets are volatile, and we know that there's an equity risk premium, which is a compensation for volatility. And the reality is, if volatility is uncomfortable for someone in a market, and you're holding equities and they're down 5 or 6%, and that's a position that gives one a sense of regret and discomfort, then equity investment is probably not for you. The reality is equities come with a level of volatility and cash doesn't. So you can be in cash. You won't get the volatility, but you also won't get the reward that comes with equity. So there's a very neat trade-off between the two with regards to expected return and volatility. And you can't get both. You can't have no volatility and very high expected returns. That doesn't exist. So unfortunately, there's a trade-off. And depending on one's personal circumstances, where you lie between equities and cash is going to, in some ways, determine your long-term returns and volatility.
There's that wise rule of thumb that if you stay in the market long enough, you will get your luck as you go along, right? So staying the course, what does that look like as an investor?
It's tough because of that asymmetry in how people feel with regards to losses and when things go up. There's a natural temptation, of course, to always try to do something when markets have gone down. And historically, those would typically have been the wrong decision. The natural temptation is to try to sell at the wrong point and buy at the wrong point. And to ride through that takes a lot of discipline and is not something that's easy to do. So the best advice often is to sit on your hands. Historically, that's what's worked out best. The problem is that won't always be what works out best going forward. And each circumstance is likely to be different. But what we can say is historically the best approach has been one of just saving as much as you can and tucking away into the market and doing so diligently and patiently.
We'll be back in a moment with pointers for new investors and what you should do in times of chaos.
Hi, I'm Jason Colby, and this is Everything Counts.
From disciplined saving to strategic investing, your Investec private banker and financial advisor are by your side. Real partnership, real progress. Now that's private banking.
Welcome back to Everything Counts. We're talking investing in times of uncertainty, talking to Investec's chief investment strategist and the host of the podcast Macro Monday, Chris Holdsworth. Chris, looking at those new investors versus experienced investors, what are those rookie mistakes that you can make as a new investor at a time like this? And what do the experienced guys usually do?
I think the primary risk for a new investor is the thought that it's easy. I mean, we see some of these stocks generating such massive returns like we have seen in the US of late. And you might think that that's the norm. You might think that that's how it typically is and that you're going to generate massive returns over short periods of time. And the reality is these opportunities do present themselves over time, but they're few and far between. And the risk is thinking that it's easy and you're going to get these high returns and taking on more risk than you actually should. Where in reality, if you get inflation plus 3 or 4 per annum, for the rest of your investing career, you're going to do very well. You see these massive returns and you think that's how it should be. That's not how it should be. That's the exception and great when it comes along. But a much more modest return over time that's still above inflation will still set people up very well. And we should be having that as our expectation in the background and rather be surprised on the upside when these good events do come through than the other side.
As an experienced investor, you're told that, it's the discipline that wins you most days, right? So what does the discipline look like when you're investing? Should you be happy with the 3 and 4% return that you're talking about, or should you be out fishing for double-digit returns?
3 or 4% real, so 3 or 4% above inflation.
Yeah,
absolutely. I mean, if you consider that your cost of living is going up by inflation, if your investments are going up by 3 or 4% more than that, over time you're likely to do very well. That will come with years where you underperform inflation by 10 or 12%, and some years when you outperform by 15 or 16%. There's a lot of volatility around that. But if just the average over time is 3 to 4% above inflation, that's absolutely fantastic. And the risk is to go and fish, as you've said, for these outsized returns and go and chase the latest fad in the hope that the money will double in the next 2 or 3 years. That is a risky approach. We need to take a diversified approach. It is the only free lunch. It's diversification. And in that way, you can hope to try to generate a real return with some volatility. But to hope to get everything all of a sudden is probably a risky approach.
I absolutely love that. The free lunch is the diversification, right? So what other mindset can you employ as somebody that's a new investor to make sure you have a good running in the long run?
The first key approach is to start early. A, because you get compounding over time, and that benefits you, obviously. But the second is it gives you more time to learn. And if you're a new investor and you've got a small capital amount, you can afford to take on some risk. You can afford to try a new approach. And you might well lose out on some money, but it won't be disastrous for you. If you're later on in your investing career and you're closer to retirement, obviously that's not something you can do. The reality is many people have done this for many hundreds of years. And the lessons have been learned with regards to how much risk you should take on and how you should diversify. If a new investor is willing to try a new approach, to try and find something, have at it. You've got an opportunity, a very limited opportunity in your investing career to do that. But as you progress, you will probably land up with the same sort of approach with regards to diversification and taking on risk that most investors, most successful investors, have adopted over time.
One thing you also hear when it comes to investing is by the time you hear about an opportunity, it's already too late at that particular point. So when do you know the right opportunity to jump at? Is this a conversation you should be having with a professional, somebody who would know whether you're in early or quite late?
These are very difficult decisions to make. And even professional investors don't always get it right. It is a very difficult thing to do consistently. If it was easy, everyone would do it, and then there wouldn't be a return. So I think there's a couple of thoughts to this. So the first is absolutely, there are professionals who spend all of their time managing funds, whose job it is to try and identify companies that are going to outperform over time. And it's worth considering whether someone should do that on your behalf if it's not something that you have the time to do. But the second point comes back to that diversification point we made earlier. A part of the reason of one diversifies is to limit your downside risk in a given event. So, for example, during COVID, there was a big sell-off in markets, and if you had a variety of assets, you wouldn't have gone down by as much. But there's another angle to diversification. If you look at equity returns over the very long run, in the main, they are due to a very small number of companies. Equity market returns are due to probably the top 2 to 3% of performers account for somewhere around 50 to 60% of equity market returns relative to cash. And so you diversify in part because of the risk we mentioned before, but you also diversify within equities to stand a chance of casting your net wide enough to grab one of these companies that does very well. Now, to come back to your question about whether it's early or late, that is a very difficult thing to do. So one of the reasons one diversifies and you have money in a fund, irrespective of whether a company is new or late cycle, is for the company to be part of that, and so that you generate returns that are above inflation, that real return of 3 to 4%. Whether it's late in the cycle or not, as I say, is very difficult. That'll be up to the fund manager or oneself to make that decision. But the underlying point is you've got to have enough opportunities to grab the companies that are actually going to make a difference.
There are a lot of conversations happening, whether at golf, paddle, at work, or your uncle over the dinner table telling you all sorts of things that could get you more money. But how do you make sure that you almost declutter and focus on the thing that matters, the plan that you have, what your portfolio looks like, and what your own personal goals are for your finances?
Yeah, when it comes to your personal finances, the best piece of advice is probably to get advice. There's a lot of complexity, and not a lot of people are very well informed with regards to how much risk they should take, they can afford to take at each point in time, how much they should have saved, how they should save. And there are people whose job it is to do that. And so the first point is to make sure that you consult with someone who can provide a path that one should follow to ensure that when it comes to retirement, that you will be sufficiently provided for.
We often hear about diversification and the fact that you can take your money offshore and try and make your money in another currency. So in uncertain times like this, what role does that actually play?
Yeah, offshore investments can be very helpful. Let's say that there is some large sell-off globally and the S&P 500 is down 10% because of some event. And normally in an environment like that, the rand will be weaker too. And so if you measure your offshore investment, like the S&P 500, in rands, it won't be down by as much. In fact, it might even be up, depending on what the rand has done. And so it does provide an element of sheltering for your portfolio if your expenses are rand denominated. If your expenses are dollar denominated, then it doesn't make much difference.
Cancels itself out.
Yeah. So it very much depends on your personal circumstance. And I think that is a key point. Everything that we say, it depends on your personal circumstances. So there's no blanket answer as to how much you should have offshore or not. It very much depends on oneself.
So what useful strategies can the new investor use in order to cushion their portfolio from major losses at a time like this?
The first thing is to seek some advice, unless one is very proficient in the space, to ensure that one is diversified. The second is an element of patience and an ability to withstand volatility. The third is pretty significant, and that comes to the allocation of one's assets. There's certain investments which might be risky in that they come with volatility, and there's certain investments which might be risky because there's a lack of liquidity or that there might be a risk of permanent loss. And these are very different types of risk, and one needs to be quite comfortable with the type and scale of risk that one is taking. It has to be a deliberate decision. You need to know what risks you're taking.
So if somebody does nothing else after this conversation, what are the 3 simple things they should be focusing on when there's a lot of noise, there's a lot of breaking news, and the Strait of Hormuz is choked up, and the price of oil has changed, there's a lot of noise. What 3 things can they do to make sure they stay calm and focus on their investment?
I think you need to have a long-term goal and plan. Secondly, you need to stick to that, and that entails probably saving as much as possible and getting an opportunity to earn that equity risk premium over time.
And as we close off, zooming out a little bit, in all this uncertainty that we're seeing, is there room for optimism?
There's lots of room for optimism. I mean, there clearly are some concerns out there, and they dominate the headlines. But also at the same time, if you look at earnings growth, for example, in the US, earnings growth for this quarter is running just short of 30% year on year. Now, if you strip out some once-off from some of the large companies, you're still looking at about 16% year on year earnings growth this quarter. And the current consensus forecast is that goes to 20% next quarter. Now, you might say, well, that's the US. But even in Europe, earnings growth is expected to accelerate quite materially. If you look at commodities, coming back to South Africa, commodity growth has been rampant, even in the current environment where there's concerns around the outlook for growth. You've looked at copper, which has done so very well recently. You've looked at iron ore, which has done so well. Gold, which has done so well over the last 3 or 4 years. Platinum has done so well. And that's very helpful for our terms of trade for South Africa, and it provides impetus for the South African economy. It helps with the fiscal position of SA. So behind the surface, behind all these headlines, these negative headlines, there are a number of moving parts which are quite positive, and that goes some way in explaining why the S&P 500, as an example, is close to a record high, and why the Rand is sitting where it is as well. So there is a lot of good news happening out there, just not on the top headline.
Chris, thank you so much for all the gems that you've dropped here on Everything Counts. If there's one thing to take away, it's this: uncertainty is part of investing, and it always has been. The real challenge isn't avoiding it, it's making sure it doesn't drive the wrong decisions where your money is involved. Now, if you want to cut through the noise like we did today, join Chris Holdsworth every Monday on Macro Monday on Investec's Focus Radio on your favorite podcast app. Well, that's it for this episode of Everything Counts. In our next episode, Everything Counts Sports Edition returns as we sit down with Bafana Bafana midfielder and Investec ambassador Teboho Mokoena. See you in a fortnight.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of the firm and should not be taken as advice or recommendations. Investec Private Banking, a division of Investec Bank Limited, a registered credit provider committed to the Code of Banking Practice as regulated by the National Financial Ombudsman.